Ladies and gentlemen, dear IFA friends, your Master of Ceremony welcomes you today in the virtual room for the WIN seminar. And before giving the screen to Jean Goulet, I want to inform you on the poster sessions that will take place after this seminar from 5 p.m. until 5:30 p.m. Central European time it is. Wishing you an interesting WIN seminar, I herewith give the screen to Jean Goulet.
Hello, I would like to introduce our chair, Ana Claudia Utumi. She is a tax practitioner, an academic in Brazil. She has an extensive network in IFA, having served on the IFA Permanent Scientific Committee, and who is now a member of the WIN Global Committee, a regional director of WIN in Latin America, a member of the IFA LATAM Committee, and director of the Brazilian IFA branch. Ana has worked tirelessly in organizing this WIN seminar, picking up the baton after Carol Tello passed away in August. I hope you enjoy our seminar.
Thank you, Jean. It's a pleasure and honor to be here in this first, very first WIN seminar, co-hosting directly from this beautiful Faith Beach, as we could not have IFA in Cancun. And I say co-chair here because originally Carol Tello was supposed to be our co-chair in this panel. It's a pity that she passed last August, but this panel is in her memory, and we do hope to make her very, very proud today. Next, please. We have an extraordinary panel. Next. We have an extraordinary panel for today, formed by Bilima Obofurido. She's director of IBFD Knowledge Center, member of the IBFD Executive Board, and chair of the Center for Studies in African Taxation. Grace Perez Navarro, deputy director of the OECD Center for Tax Policy and Administration. Monique van Hersken, partner at Simmons & Simmons, member of the UN Transfer Pricing Subcommittee, consultant to UN Committee of Tax Experts, and lecturer at Vienna and Maastricht universities. Patricia Mongo-Vanit, member of the UN Tax Committee and former member of the Thai Revenue Department. Robin Chesler, international tax partner at Baker McKenzie in San Francisco, and Shefali Guradia, partner at Deloitte in India and panelist at the Recent Developments panel next week. Sheila Lawler, head of tax EMEA and corporate at Experian, to bring us insights from a corporate viewpoint of what we are going to discuss. And last but certainly not the least, our dear secretary, Fabiola Diaz Prado, chair of WIN Mexico, partner at Anaya Abogados, who helped us with fresh ideas and much hard work to put this panel forward. So, next, please. This panel is not about the OECD pillars that will be discussed next week at the IFA OECD panel, but rather about actual unilateral implementation of taxation of digital economy, as well as some consequences of such measures. We'll start with an overview of the evolution of digital economy and taxation by Jean Goulet, our chair of WIN Global Committee. Jean has spent her career in public accounting and 25 years at IBM, where she served as director of tax and witnessed much of the advances in digital economy. After leaving IBM, Jean has continued to work as US tax consultant for tax startups going to the US. Even though it's difficult to summarize so much knowledge in 5 minutes, Jean kindly agreed to prepare this interesting overview we will watch shortly. Then we will have a policy viewpoints with insights on the importance of having international coordination in tax digital economy, following by comments on the types of measures that countries of different regions have adopted. One country stands out, India, due to implementation of different measures. After, we'll see the consequences of those isolated measures, especially from a corporate and US viewpoints. And in our final rounds, panelists will present some concluding remarks and perspectives. And of course, this session could not end without a tribute to Carol Tello. Most of us here in this panel would certainly have a lot to say about her, but we asked Peter Connors, IFA USA chair, to share a few words about her and about IFA USA initiatives in Carol's honor. So please use Q&A for questions and include whether it's directed to any specific panelist or not. We cannot assure we'll have time to answer them, but we'll do our best to pick few of them in the end to comment. So let's start with Jean's video. Fabiola, please.
While at IBM, I was involved in both the tech industry and tax policy. I will briefly discuss some of the history of tech and the role tax played. I hope to provide some context for the recent tax proposals for the digital economy, which are the topic of our webinar today. Often overlooked are two key features: investment and risk-taking. Let's walk down memory lane and see how this played out. Historically, hardware and software were physical in nature and inseparable: vacuum tubes, wires, and switches. In 1964, IBM launched System 360, which represented the birth of the software industry. As software became unbundled from hardware, computers no longer needed to be programmed individually for the specific task or customer. More important, IBM bet the business by making a $5 billion gamble, valued at $41.5 billion today, for a new product that would cannibalize the existing product lines. Tax accommodated in 1969. The IRS agreed that software, like hardware, should be expensed and treated as R&D. For treaty purposes, withholding tax was applied to software revenue as it was considered to be an intangible, thus royalty income, until 1998. In 1976, Apple launched its first personal computer. Then in 81, the IBM PC emerged with the DOS operating system developed by both Microsoft and IBM. Application software began to proliferate. Tax rules in the US accommodated the industry further with the enactment of the R&D credit for both hardware and software. From a treaty point of view, a withholding tax on software became untenable due to the large cash need for new investments and the enormous losses incurred by these new companies. The US foreign tax credit cannot be utilized if there are losses. In 1993, the World Wide Web became available commercially. This led to a boom in startups. Investment flowed and fear of failure vanished. To support the industry, in 1998, Regulation 861-18 was enacted, which characterized certain software transactions as copyrighted articles, meaning goods. Now such software could fall under Treaty Article 7, business profits, while only some transactions relating to copyright rights would continue to be subject to Article 12. That solved the withholding tax problem. Our colleague and friend Carol Tello worked at the IRS on these software regulations. The startup boom of the 90s turned into the dot-com bust in 2000, where only a few survived and nearly 80% failed. There was an overwhelming loss of invested capital. Nevertheless, both the IRS and the OECD continued to support e-commerce. In 2002, the OECD issued a tag report on treaty characterization, which adopted much of the US -18 regulations. Governments did not want to kill the goose that would lay the golden eggs. Appendix C and D list some of the accomplishments of the OECD. By the end of 2010s, it became clear that innovation was not spread evenly across the globe. From mountains of failures, only a handful of successes emerged, mainly from the US and China. As we look to the future, what is of even greater concern is the uneven distribution of capital investments, and risk-taking in most countries. One measure is to look at the emergence of unicorns, startups valued at $1 billion, the crop of potential future giants who may even overpower the shiny stars of today, as Apple did to IBM. Shocking. In a pipeline of 494 unicorns in 2020, there are 239 in the US, 118 in China, but only 137 in the rest of the world. The largest of them all is a hectacorn in China, ByteDance, owner of the TikTok app, which I'm sure you've all heard of. What accounts for such a large concentration of entrepreneurs, builders, and creators in so few countries? Are nations of the world satisfied to be merely consumers in the digital economy and thus avoid upfront investments and risk-taking? In a dynamic industry such as tech, if entrepreneurship, building, creating are important, then do any of the tax measures under consideration support these objectives? The digital services tax, a revival of withholding tax, OECD Pillar 1 and 2, or simply a consumption tax? I leave you with Appendix A through D in the app currently to view further details. And on that note, I hope you enjoy our webinar.
Thank you, Jean. Thank you so much. And next, please. And so now it was very good to have this overview, and now to start our discussion with the policy viewpoint. Grace, please.
Thank you, and thank you, Jean, for that excellent historical perspective on the taxation of the increased and digitalization of the economy. There remains an urgent need to update the international tax rules to address the current situation where multinationals can engage substantially in the economic life of an economy and derive substantial profits therefrom without having a physical presence, which results in no taxation in that economy. We can see that the pandemic is accelerating the digitalization of the economy, and we need to ensure that the international rules address these fundamental changes. This is a matter of fairness to businesses, ensuring that digital businesses do not gain an advantage vis-a-vis more traditional businesses engaged in similar activities. For digital businesses hit by digital levies, which are imposed on a gross basis, there is a fairness issue vis-a-vis businesses that are taxed on a net basis. There is an issue of fairness across countries in the allocation of taxing rights and perceptions of fairness of the man on the street who regularly sees headlines of some multinationals paying little or no corporate tax anywhere while they continue to pay. There is also the advantage to developing countries having a multilaterally negotiated solution, as they don't always have the same bargaining power in a bilateral context. Look at our multilateral conventions. How long would it have taken the 161 members of the Multilateral Administrative Convention for Cooperation in Tax Matters to negotiate EOI arrangements bilaterally? We also need to think about reducing tax barriers to cross-border trade and investment. Having a common, consistently applied solution provides greater tax certainty and predictability for taxpayers and governments, and also can help keep compliance burdens to a minimum by establishing common rules that everyone can apply and common documentation requirements. We need to avoid that tax wars become trade wars, and we've already seen a bit of that. Do we really want tax disputes dealt with in a trade context, having trade experts dealing with tax issues? Do governments and businesses want to be waging this war on two fronts? We've seen from the sidelines a bit of the turf battle in the US between Treasury and the USTR, and this issue is no doubt coming up in bilateral trade negotiations with countries that have implemented unilateral measures. We need to also think about preventing the negative impacts on the economy and on growth. And if we go to the next slide, we'll see what the counterfactual to the current situation is versus not having any multilateral solution. And so if we can move to the next slide, please. Thank you. This slide shows the work we've done to assess different scenarios on growth. On the left, the blue bar shows the impact of our proposals on growth. Pillar 1 and Pillar 2 would lead to a relatively small increase in the average post-tax investment costs of multinationals. The ensuing negative effect on global investment is estimated to be very small, as the proposals would mostly affect highly profitable multinationals in the digitalized and intangible intensive sectors in the case of Pillar 1, and on multinationals engaging in profit shifting in the case of Pillar 2. Overall, the negative effect on global GDP stemming from the expected increase in tax revenues associated with the proposals is estimated to be less than 0.1% in the long term. Pillar 1 and Pillar 2 would support global investment and growth through less quantifiable but nonetheless significant channels, which may partly or even fully offset the small negative effect. In particular, the proposals should increase tax certainty and could enhance the efficiency of global capital allocation by increasing the importance of non-tax factors in investment decisions. They may also reduce the need to raise revenues by implementing other and potentially more distortive taxes in the post-COVID environment. In contrast, in the absence of a consensus-based solution, we would likely see even more uncoordinated and unilateral tax measures, as well as more tax and trade disputes. On the right of the slide, you have different scenarios to illustrate the impact of not having a consensus-based solution. Now, the magnitude of the impact on economic growth depends on the level and scope of unilateral measures and the intensity of retaliatory measures. The impact is more adverse in a no consensus situation than a consensus scenario. In the worst case scenario, which you see on the slide, these disputes could reduce global GDP by more than 1% and would reduce trade and investment, but would also affect household incomes, reductions in wages, and higher prices of household goods. Further tax and trade disputes could add to the already daunting economic challenges resulting from COVID-19 and the slow recovery. Thank you.
Thank you, Grace. Thank you so much for these interesting views. And we will now start to discuss some types of measures that have been adopted by different countries of different regions and some of the consequences. So we now start with Belima. Belima, please.
Thank you very much, Chair. Thank you. Well, I will be talking about measures, the African experience to date. And the first thing to note, of course, is that in terms of an economic and political landscape, Africa is no different from the rest of the world in seeking to tax digital income that arises in its jurisdiction. So what I'll share with you for my 10 minutes is I'll start by highlighting the role of the African Tax Administration Forum, ATAF, which is a forum for African tax authorities and helps to set policy for tax across the board in Africa. ATAF has issued guidance to African countries on how they should draft digital service tax legislation. So I'll give some highlights on that guidance. I'll then give a broad overview of the sort of unilateral measures we see across Africa, those that have been implemented and those that are in consideration at the moment. And then I'll narrow down onto one particular jurisdiction and say a little bit about that. So first, the ATAF guidance. This guidance was actually issued only last month in October, but it's therefore worth noting that various African countries had already started introducing or implementing measures way before the guidance. And what ATAF has done is it's created a draft legislation template for countries that want to put in place DSTs, digital services tax. What this template does is it only focuses on digital services taxes. So if a country wants to introduce another type of tax, for example, a digital PE, that's not covered by the ATAF guidance. And the gist of the ATAF legislation template is basically that African countries should levy a digital services tax. It should be levied on digital services revenue that is attributable to that particular country, where this revenue relates to online advertising services, data services, online marketplace services, digital content services, gaming, cloud computing, and then there is a catch-all for any other digital services. The guidance also includes recommendations for the DST rate. ATAF proposes a rate of between 1% and 3% on gross revenues. Also guidance on how to determine the amount of digital service revenue. Also guidance on threshold for in-country revenue. Also guidance for administration issues such as filing obligations and appointing a local representative. So that's what ATAF has been busy doing. But what have the African countries actually been doing? As I mentioned, a lot of them were already on this journey before the guidance came out last month. And now let's look at the types of taxes that we are seeing either being introduced or being contemplated. First, DST type taxes, such as the ones ATAF is recommending. Kenya has several months ago introduced a digital services tax that should take effect from next year. That's 1.5% on the provision of services via digital marketplace. Tunisia is also planning something similar. And these are the types of taxes within the ATAF guidance, although introduced before then. There's, of course, talk about withholding taxes that will come in by expansion of the source rules. Some countries are looking the way of digital PEs, for example, the significant economic presence rule in Nigeria, which I will zero on in a short while. Some countries are looking at having a general income tax, just the normal general income tax we know and love, but extending it to catch certain digital services. And of course, a wide range of indirect taxes that already exist, but tweaking them to catch digital services. However, not every country has introduced something. Some countries, for example, Egypt, have announced the intention, but we're still waiting for further detail. Other countries have said we prefer to wait for a global solution. And at least several months ago, that was the position of South Africa. So now let's zero in on one particular jurisdiction and see what that jurisdiction has been doing. So I'd like to select Nigeria. And why Nigeria? Because I've just described to you the fundamentals of a digital service type tax, such as being recommended by ATAF. So let's look at another type of tax that's not a DST, but also designed to catch digital services. And that's, in this case, is the digital PE tax. That's a type that Nigeria is going for under its significant economic presence regime, which it introduced this year. This regime has retrospective effect from the 3rd of February of this year. It covers both digital and non-digital services, but of course our concern here is the digital services. So when does this tax bite? There are 3 possible cases before a taxpayer will fall within this tax. The first case is a non-resident taxpayer that has gross revenue turnover from Nigeria of more than 25 million Nigerian naira. That is 55,000 euros, 55,000 euros, from a combination of activities or any one of certain type of activities. I'll mention the activities later. That's case 1. Case 2, a company will be caught by these rules if it uses a Nigerian domain name or registers a website in Nigeria. There is no threshold. Just having a .ng domain name is enough to bring a company within the scope of these rules. Case 3, where a company has a purposeful and sustained interaction with persons in Nigeria by customizing its digital outreach. For example, using localized billing, localized payments, that is enough to bring that company within the ambit of these rules. Again, no threshold is required. So now let's look at case 1. Case 1 is where I mentioned a company that has revenues from Nigeria of over 55,000 euros from certain types of activities. What are these activities? The usual ones: streaming and downloading of digital content, transmitting data collected from Nigerian users via digital interface, providing goods and services via digital platform into Nigeria, providing intermediation services or online marketplace between suppliers and customers in Nigeria. Doing that and exceeding that threshold of 55,000 will bring that company within the ambit of the Nigeria SEP rules. I just want to make a few points about these rules. You'll recall that some years ago, the OECD said, right, we're working towards a global solution. We know that many countries might not have the patience to wait and might therefore introduce some unilateral measures. Go ahead, we can't stop you, but please bear some considerations in mind. One of which was, if you introduce such rules, try to make them temporary so that they can be repealed when the digital solution is on the table. And across the board, that's what countries tend to do. They make these rules on a temporary basis. Has Nigeria done that? Not really. Nigeria has provided that its rules will only be withdrawn if the global solution covers all the scenarios that are contemplated by its rules. So if it does not, then these rules will apply side by side with the global solution. So it's not going to withdraw the rules unless it is absolutely certain that the global solution envelopes the entire situation envisaged by Nigeria. Another thing worth noting is that because this is a kind of digital PE, if Nigeria is party to a treaty with another country, and that treaty, of course, has a PE provision, the treaty will override Nigeria's domestic rules. Therefore, this domestic rule will only work in cases where Nigeria does not have a treaty with the other country. Other thing I want to note is that that threshold for case one of 55,000 euros is quite low. Yes, of course, it's Africa, so you have to revise downwards, but it is still Nigeria, which is still a big economy. It's very, very easy for a non-resident taxpayer to hit that 55,000 threshold very quickly. And for cases 2 and 3, where a company will be brought within the net just for having an NG domain name or localized billing, there is no threshold at all. Therefore, these rules have very wide application. And because these rules are very wide in application, they raise significant questions as to the implementation success. Thank you.
Thank you, Belima. Patricia, please.
Yes, for me, I would like to touch upon the unilateral measures that is adopting or will be adopted by the ASEAN countries. Let me start with Indonesia. Earlier this year, Indonesia has enacted the law regarding the unilateral that they will tax the corporate income tax for deemed PE of overseas e-commerce companies with significant economic presence in Indonesia. If PE cannot be deemed due to an existing tax treaty, what so-called electronic transactional tax or ETT will be imposed on direct sales or sales through marketplace. What is interesting is that I cannot find further. It is said that significant economic presence criteria, rates, or imposition basis and procedures and the ETT provision will be stipulated under the MARF decree, which I don't think it has been released yet. The latest news I have seen is that the finance ministry said that Indonesia will wait for global consensus on digital tax rather than implementing on its own. So let's wait and see how Indonesia will do later on. Next will be Malaysia. Malaysia says that there will be a tax treatment on digital advertising provided by non-residents. Payment made to non-residents digital advertisers without PE or business presence in Malaysia will be subject to withholding tax. But rules regarding this withholding tax vary, depends on types and payment, which the details have not been circulated yet. Next is Vietnam. Vietnam says that they will have the payment made to non-resident e-commerce businesses will be subject to new withholding tax to be collected by financial intermediaries. Withholding tax will apply to all designated B2C, B2B transactions. Rates are to be determined, and the effective date will be January the 1st this coming year. So, but the details are not there yet, so we have to wait and see. The remaining countries, Singapore is very clear on that, waiting for next slide, please. Singapore is very clear, waiting for global solution. For Thailand, we proposed a withholding tax on digital advertising last year, but the proposal was dropped during the hearing, the draft bill hearing. So right now, Thailand is still waiting and seeing. As for the rest of the ASEAN country, Brunei, Cambodia, Laos, Myanmar, and the Philippines, there has not been a proposal yet regarding the unilaterals. That's all for me. Thank you.
Thank you, Patricia. Thank you for summarizing the Asia measures. Shefali, please.
Thank you, Anna. So I will talk a little bit about India's journey on digital taxes. India, of course, has been famous for the unilateral actions that it has taken and brought in many of these taxes very early on in its domestic law. Way back in 2016, it introduced a service tax, which was more of an indirect tax on the digital services that were provided through electronic means. And then after that continued in the form of the goods and service tax, which was introduced in 2017. So we have already an incidence of 18% GST on something which is called as OIDAR, which is Online Information and Database Access Services. In 2016, India introduced equalization levy. And again, this was more of taking from the recommendations, or not recommendations, but one of the measures that was considered by the BEPS Action 1. And based on that report, there was a committee that was set up in India to look into all the different measures which were considered. And the committee did recommend equalization levy as one of the measures for taxing digital payments. India introduced a 6% equalization levy in 2016 on all online advertisement services. Now, this was again just a non-resident providing services to Indian residents. The incidence of levy was actually on the Indian payer. The compliance had to be done by the Indian payer. This levy is still there on all inbound advertisement services. And the Indian payer deposits the tax. So at least in terms of the filings, the non-resident is not really required to do anything on this count. But there is a 6% levy on all advertisement services, on the digital advertisements. In 2018, India also introduced significant economic presence in the definition of business connection in its domestic law. Now, business connection is a concept which is similar to permanent establishment. It's a little broader concept, but it is a concept under the Indian domestic law. Of course, wherever India has a tax treaty, the treaty prevails over the domestic law. So the treaty definition of permanent establishment, if that's narrower, that will continue to prevail. But India did introduce a significant economic presence, which comprised of any transactions of goods or services that were done in India, or any engaging with the users in India, any user participation, or soliciting of business through electronic means in India. While this measure was introduced in 2018, no thresholds were announced, and they are yet not announced. And very rightly so, I think India has also taken an approach that they would wait to see whether there is a global consensus developing on Pillar 1 or on digital economy taxation. And only after that, they would try and activate this. But at least the provision is now all there. And now they have deferred the significant economic presence definition till 21-22. The last, of course, 2020 of April 1, 2020 is when India expanded the scope of equalization levy and introduced a 2% levy on all e-commerce operators that were selling goods or services to Indian residents, or that were facilitating sale of goods or services to Indian residents. Now, of course, in addition to selling into India, it also covers all such transactions where the customers are using Indian IP address to purchase these goods or services, and they would also be covered within the scope. Now, while this says that this is a levy on all e-commerce operators, this is a very, very broad levy. And when you compare it with many of the European DSTs, which are already there, some are already announced and already implemented, whereas the others have been announced and deferred, but most of them apply to largely digital transactions, whereas the Indian equalization levy applies on all transactions in goods, services, and not only that, even the physical goods or services, if they are sold on an electronic platform, then even that is within the scope. So it's a very, very broad levy. Of course, it was introduced more just about the time when COVID was breaking out in India, and was done in a bit of a hurry without too much of a prior consultation with the stakeholders. Therefore, there wasn't enough time and opportunity to engage with the government in terms of how this levy can be implemented in Indian context. but the government has very well gone ahead and done this. It is a quarterly payment that many companies have already started paying in India. And it is interesting to note that, we don't have many of the exclusions that are there in the context of DSTs. So, for example, if there is an intercompany transaction where some goods or services are being purchased, even then it would be within the scope of equalization levy. Likewise, we don't have any exclusions for any financial service activities or regulated activities as well. So these are some of the asks, but nevertheless, at least this levy is something which is already off the ground. This levy also applies to any transaction between two non-residents when it relates to a payment for an online advertisement which is targeted to Indian customers. So again, it is a focused levy, which is anywhere where any company is benefiting from the user data from the Indian market. I think this levy seems to cover that. If there is any sale of data itself, even that is covered. Interestingly, in last budget, I think India also amended the domestic law to bring within its scope of all such foreign income as accruing or arising in India, so that India gets that natural right to tax this income. Some of the controversies which are there is, since this levy is not within our income tax law, it is neither an income tax nor is it an indirect tax, since we already have the GST. It is often debated as to what really is this tax. Is it in lieu of income tax? Because interestingly, Indian equalization levy provisions, the way they have been introduced, they do seem to be somewhat like a substitute for an income tax, because it does give a corresponding exemption from income tax. So if the income is subject to equalization levy, then you have an automatic exemption from income tax. Now, this is where there is this whole classic debate on, under the Indian domestic law, we also have the software payments, which are treated as royalty, and they are subject to a withholding tax. So if a withholding tax applies, whether the equalization levy of 2% would apply, or can one say that, no, I would pay equalization levy and then I will not pay the withholding tax? So these are some of the gray areas which companies are still awaiting clarifications on. But it is an interesting feature for the Indian equalization levy that in order to avoid double taxation, India chose to grant a specific exemption from income tax for all payments that were subject to equalization levy. And as I said, this significant economic presence is something India has got in its domestic law, but it's not yet activated. And India is likely to wait and watch to see, how the global consensus evolves on this before it actually starts implementing some of these measures. So that's all from my end. Back to you, Anna.
Thank you, Shefali. You see now how interesting are the Indian aspects here. So many measures implemented. So now we are going to move to Gremlins, in fact, to Europe. So Monique will walk us through what are the measures that European countries are taking.
Thank you,
Monique,
Anna.
please.
Thank you, Ana Claudia. Thank you. So, you have to have some humor if you work in tax, right? You can't do without it. I think that the European digital taxation developments are a bit of a parody on the 1984 horror comedy by Steven Spielberg called Gremlins. Just for those who haven't seen it, really quickly, a boy gets a pet for Christmas. It's a gremlin called Mogwai. And there are three really important rules to deal with this pet. First of all, it cannot be exposed to light because it hurts when it's exposed to light. So that has to do with, whether there's enough transparency, I think, is the connection. Second, it multiplies if it gets wet. Well, you can see that the digital service taxes got rained on big time globally. And the third one is probably the most important one. It can never, ever, ever be fed after midnight, however hard it begs for food. Well, those who've seen the movie knows how this is going to evolve, right? So next slide, please. Since November 2018, the European Council has been debating the proposal of a digital services tax. Although interestingly, in a July 2020 tax package that was adopted considering COVID, digital tax was not at all part of that. So the proposal that the European Commission put on the table consisted of two parts. There was an interim digital service tax proposal and a long-term proposal. So let's go to the interim proposal. The interim proposal is that there would be a digital services tax on revenues, and this is gross revenue. And this is revenue that results from placing on a digital interface advertising targeted at users of that particular interface. Sounds familiar. Next, also making a multi-sided digital interface available to users so that they can find each other, like, you know, the eBays and the like. You know, how do you, or the Marktplaatses in the Netherlands, or, you know, how do you have people meet each other and find each other when they're buying and selling to each other? And then finally, the revenue to be included in this tax is the revenue resulting from transmission of data that is collected about these users and generated from the user activities. That revenue would be taxed at a 3% gross rate. So according to the EU, the effective average tax rate in the 28 EU member states is about 20.9, but 21% for traditional domestic business and about 23.2% for traditional international businesses. If you look at digital international business, business to consumer, the estimate is that it's only 10.2%. And if you look at digital international business income or businesses, business to business, it would be 8.92%. And if you would look at the effective average tax rate for digital domestic business, it would be 8.5%. So those are extremely low effective tax rates, which is why arguably that 3%, you know, shouldn't, be an unreasonable tax burden. This would not apply to everyone. There's a threshold. The threshold would be the worldwide revenue by the entity being more than 750 million euro. The total taxable digital service revenue by the EU entity per year is supposed to be more than 50 million. That was the initial proposal. Last Friday, the EU published an updated proposal where that was adjusted to 40 million euro. And I think it would apply, this particular interim solution would apply for 2 years, and after that it's going to be reviewed, you know, how it's working and what the status of it is, and whether we can move to the long-term proposal. The idea is that this would generate about 5 billion revenue per year at a 3% rate. It would be filed by self-declaration by the taxpayer, and the digital service tax statement has to be submitted electronically for each tax period within 30 days to a digital portal. Also for those dealing with VAT, not uncommon. So let's go to the long-term proposal then. Next slide, please. So the long-term proposal is a corporate tax. So it's not a separate tax on gross revenues, it's a corporate tax. And the digital nexus would be established if the following conditions are met. First of all, annual income in a member state would have to be more than 7 million, or the second test is the users in the member states per year would be more than 100,000, or third, the business contracts for digital services concluded with users in the member state is more than 3,000 per year. So you have more than 3,000 business contracts. If you meet that, you would have a deemed permanent establishment. Well, we know how to work with a permanent establishment. You know, we know how to do that. So the profit attributable to that significant digital presence would then subsequently be determined by application of the OECD authorized approach, which is more or less what we do for transfer pricing anyway, right? It's a functional analysis, and there would be specific criteria for identifying significant activities for a digital company, and those would include collection, storage, processing, display of data, and sale of online advertising, et cetera, et cetera. So that long-term proposal, of course, if everything would have gone well and everybody would have agreed, this all setup would have started as January 1, 2020. But we're not there. We're not there. Let's go to the next slide, please. So what is the status of the digital service tax proposal? Well, we needed unanimous consent by the 28 EU member states. That's the basis on which the EU operates to implement the interim proposal by January 2021. No consent was obtained, however. In particular, Sweden, Ireland, and Denmark had issues. And let me be clear, those were not unreasonable, the issues that they had with it. But anyhow, that meant that we were not going to go forward with this. However, so the EU said, you know what, we're going to back the OECD proposal. We're going to make sure we get one international solution rather than have, a block of countries do something totally different. But, the OECD proposal, of course, is not moving forward, unfortunately, as swiftly as it should and could, and everybody would have wanted. And then the EU, came back and said, well, we're going to put this long-term proposal back on the table. In October, I think the EU Commission came out and said it would tolerate a delay by the OECD, but not for much longer. Okay, well, where are we now? Next slide, please. Back to the gremlin story, right? So now we have, somebody fed the gremlin after midnight and didn't heed the instructions. So now many EU member states are going at it on their own. The OECD should have done it, not the EU. Ireland, Sweden, Denmark rejected the proposal. One argument was that, the interim solution would violate tax treaties, all legitimate, but we are where we are. So where are we? Let's go to the next slide, please. So this is just a summary overview, and I see that, some countries may not even be on here. But Austria, France, Hungary, Italy, Poland, Spain, Turkey, and the United Kingdom have implemented a form of a DST. Some have published proposals to enact a digital services tax, and Latvia, Norway, and Slovenia have officially announced or shown intentions to implement such a tax. The Netherlands, Ireland, and Luxembourg had strong reservations against the EU proposal in the very beginning. The Netherlands still is not, moving forward on this and seems to take a wait-and-see approach. But what did happen was that last Friday, the 13th, for whatever reason, the Commission proposed or published the digital common system, the digital directive as amended. And it basically says that, well, the short-term solution should be agreed without delay by the EU member states. And I actually pull up the printout of it where, there's several amendments to the original proposal where it says, although the need to adapt corporate tax rules to the digital economy is recognized at international level by bodies such as the G20, reaching an agreement at global level is likely to be challenging. That's where it ended at first. And now it says, and not taking place in the near future is being added. So there are several amendments. The threshold is reduced a little bit. But yeah, the European proposals are squarely back on the table and moving forward. With that, I hand it back to you, Ana Claudia.
Thank you, Monique. Thank you. I really, really enjoy the gremlins and the comparison with the gremlin story.
They'll be back. They'll be back. We'll see them later on.
Very good. Well, and briefly speaking about the LATAM unilateral measures, we see some countries adopting withholding tax, not on all digital service, but on certain digital services, such as it's the case of Costa Rica, Mexico, Paraguay, Uruguay. We have DST-like tax in Argentina. It's not a real DST, but it catches digital services as well. Chile tried to implement the 10% DST, but was rejected. And it's very interesting, the case of my home country from Brazil, that let's say the ordinary law, regardless of the digital economy, they've already had, in the ordinary law, we've already have Pillar 2 like measures here in Brazil, with a broad scope of withholding tax, which includes all sorts of services, including digital services. We have a very broad general CFC rules, doesn't matter if it's a tax haven jurisdiction or not. And we have rules forbidding deduction of expenses incurred with tax haven jurisdictions or low tax regimes. And on the top of all of that, we still have DST law project in the Brazilian Congress. In fact, it's not one project. We have 8 different projects under discussion. But of course, that I hope that these projects don't move forward, because we have too many taxes already here in Brazil, and we have too much in terms of amounts being levied on the foreign companies that come to operate here in Brazil. But one point that we see here is that none of the countries that they've already had any kind of measures in digital taxation has adopted anything that resemble Pillar 1, or digital PE legislation. So it's more on the withholding tax side. And with this, we finished this first round of types of measures that countries in different regions are doing. And we'll start speaking about the consequences of those isolated digital taxation measures. And we start with Sheila giving us the view from the corporate side. So Sheila, please.
Thanks, Ana Claudia. From the corporate's perspective, a major issue with direct revenue-based digital taxes is the gross nature of the tax. Where a company has qualifying revenue, the tax is going to be payable whether the taxpayer is making a loss or a low profit margin. And indeed, the lower the profit margin, the higher the hit to the business. So a direct revenue-based tax is automatically going to be of much more interest to the business and to the commercial people, and not just to the finance and to the tax groups, as it will be a direct above EBIT cost. So will need to be factored into business plans, will need to be factored into pricing. Businesses impacted would expect to see a hike in its cash tax rate, and thus its cash flow impact. So as you can imagine, having various taxes, rates, etc., is going to be a lot more challenging for business when coming to this kind of planning. Then we have to layer on top of that the fact that because there's been a failure to reach consensus means that we are seeing a lot of inconsistency with the unilateral measures. So as we've previously discussed, some jurisdictions are proposing a direct revenue-based tax, but also broadening their indirect tax regimes, either separately or as part of a DST proposals. India and Russia, we see, are going with an indirect tax route. And of course, then we have the Indian equalization levy. We see Vietnam, Thailand, some of the LATAM countries going with the withholding tax. I'm not particularly close to Asia Pac these days anymore, but my understanding is that the indirect tax route is proving to be very popular there. We're also seeing quite a variation in rates with where we have a proposed DST. Whilst a lot of jurisdictions are alighting around the 3% mark, we see Turkey coming in at 7.5%. We see some of the Asia Pac jurisdictions coming in even higher. Then, of course, we have inconsistency around thresholds. So while the global thresholds do seem to be pretty similar, around the, similar to the EU, the 750 million euros, though do caveat, there are certain inconsistencies around whether global thresholds include all income, or in the case of the EU, just qualifying revenues only. So at least we have a certain level of consistency with the global thresholds, but as we can see, local thresholds are varying as well, with a lot of jurisdictions, particularly in the EU, coming in at much higher levels. Some of the, including the EU, jurisdictions have much lower local thresholds. Spain is 3%, Italy is 5.5%, and as we just heard there a few minutes ago, Nigeria is 55,000. So businesses obviously providing qualifying services in these jurisdictions are possibly going to be impacted much quicker. And then, of course, as we know, that there is quite a cliff. Once a company exceeds a threshold, that they'll be fully chargeable to the DST. So that's we're dealing with thresholds, rates, etc. There is, as we know, a lot of lack of clarity in terms of what revenues are impacted, and certainly from experience perspective, you know, we are finding a certain amount of difficulty in interpreting proposed legislation. And then on top of that, there's inconsistency among jurisdictions as to what revenues are actually impacted by DST. So some proposals cover purely advertising services, some include intermediary platforms, search engines, etc. And some proposals have yet to even clarify in-scope revenue, which makes it very difficult for companies to try and forecast potential impact. So as Belima mentioned earlier, whilst the likes of the ATAF guidance mentioned is hopeful, the catch-all, any other digital services taxes, is not particularly helpful, because, you know, it just brings us back to that level of inconsistency and lack of clarity. So even when we hopefully will have further clarity per jurisdiction, a lot of companies unfortunately don't currently have the tools to actually track products on a global and a local level. And that is going to have to be done on a real-time basis. Obviously, it would be much simpler to track these things where there is absolute consistency in the taxes. But as we can see, it's going to prove to be much more challenging with these inconsistencies in place. And, you know, another issue that we're seeing and we're certainly nervous about is, you know, given the types of services that are impacted, and particularly where we have direct tax on revenues, there is a risk of this cascade effect, where a digital service tax could be levied at different points on the value chain with no input credit, unlike a VAT. So, and it's also very clear that tax credits or the tax treaties are not going to provide for double tax credits. So again, there's a higher risk for the taxpayer that having various competing provisions could result in double or even multiple taxation. And then finally, which probably from my perspective is going to be most challenging, the introduction of various digital service taxes is going to impose a huge compliance burden on taxpayers, which clearly is contrary to OECD policy. Where we have multiple systems in place, this is going to make it even more cumbersome for companies and for taxpayers. Firstly, systems are going to have to be, IT systems are going to have to be amended now to capture revenue taxes. I mean, anyone who's been involved in amending systems for something as simple as a VAT rate change can tell you how difficult it will be. So, you know, how IT systems or the IT departments are going to have to upgrade systems for all these new revenue taxes and potentially multiple types of taxes is going to involve quite a huge system upgrade for a lot of companies. What we're going to have to see are IT systems that talk to our accounting systems and track in-scope revenue, payment amounts, payment dates, particularly if these are going to be on a regular basis. If we have different deferred tax, digital services tax in different jurisdictions, this is going to make it even more and more difficult. So basically, I think what's going to happen is that taxpayers are going to have to start investing a lot more time and a lot more resources, firstly, to decide whether they're even impacted, whether they're even in or out of a DST system. And then, of course, there is going to have to be continuous ongoing monitoring. If we look at this in isolation, it's difficult enough, but bear in mind, companies are also starting to see the impact of other recent compliance burdens, mandatory disclosure requirements, country by country reporting is another one that comes to mind, on top of various local obligations. So from a business perspective, we see a lot more compliance burdens and a lot more compliance costs being added to tax departments over the last couple of years. And to be perfectly frank, compliance costs are sunken costs of a business and are costs that will not be used to go into investment into the business. So ultimately, I think everything ultimately will boil down to whether corporates are able to track the taxes and are able to comply with the taxes in an efficient and a real-time basis. And pretty much, it's just something that we're taking, an almost a wait and see approach on. So that's pretty much it for me at this point.
Very good, Sheila. It's interesting that this point of compliance and all this costs and impacts to corporates to be taken into account in this digital taxation world. And now we move to the U.S. That Grace touched very briefly, and now Robin will walk us through the U.S. Please.
Thanks, Anna. Unlike those other 25 countries or the gremlins, the United States does not impose any digital services taxes, and instead taxes digital services income in the same manner that it taxes income from any other business. It may not be politically correct to say this, but the United States and certainly the US-based multinational companies who are impacted by the DSTs would greatly prefer that the other countries would do the same as the United States. In other words, no DSTs. That, however, is extremely unlikely to be the outcome for two reasons. One, as Jean pointed out at the beginning of the presentation, most of the companies that will be impacted by the DSTs are US-based multinational companies. And the other countries, China has some also, but most of the other countries have only a de minimis number of companies that will be impacted. So in a lot of ways, it's sort of a one-way street. And second of all, because of the global, sorry, I'm getting questions from panel members here. The other reason that it's extremely unlikely that there will be no DSTs is because of the global financial crisis. Countries are under tremendous pressure now to collect taxes, and this is a great way to collect taxes for the various countries. And the shelter in place from the global pandemic has certainly accelerated the move to digital services, further increasing the amount of potential taxes that can be collected as a result of the DST or through the mechanism of the DSTs. So what is the US government response? If we could go to the next slide, thank you. The US response, there's three different categories of US response, and they're all defensive. The first one is under Section 301 of the US Trade Act, which allows for retaliatory tariffs France was the first country to enact a DST, and if we can go to the next slide, France enacted the DST in July of last year, and immediately after France enacted the DST, which is it's a 3% tax on gross, and it was retroactive to January 1, 2019, so 6-month retroactive. Immediately after France came out with that, Trump sent out a tweet, which you can see in the corner there, saying, France just put a digital tax on our great American tech companies. If anybody taxes them, it should be their home country, the USA. We will announce a substantial reciprocal action on Macron's foolishness shortly. I've always said American wine is better than French wine, exclamation. Indeed, 6 months later, the US Trade Representative issued a decision in the 301 investigation on the French DST and concluded that the French DST is unreasonable or discriminatory, and it burdens or restricts US commerce, and therefore up to 100% additional tariffs are authorized to be imposed. The following month, in January 2020, there was a further negotiation between the United States and France, which didn't come out so well for the United States. The result of that negotiation is that France agreed to suspend the collection of the 3% DST. So the DSTs were still accruing, but they just wouldn't be collected until December of this year. And in exchange, the US agreed to delay the imposition of the new tariffs until January of next year. And the idea or the thought was that in the meantime, this would allow the OECD consensus or unified approach to progress. And it was all dependent on the OECD coming to an agreement in the fall of 2020. It's now past middle of November of 2020. And even Pascal Saint-Amans, who is head of the OECD project, has acknowledged that no agreement has been reached. A lot of progress has been made and blueprints, but no agreement has been reached. Therefore, as between the US and France, France is going to start collecting the DSTs next month, and the United States is going to start imposing the additional tariffs in January. You can see in the middle of the slide here, the font may be too small, so I'll read it out to you. The categories of products upon which the new US tariffs will be imposed. So the products are lipstick, eyeshadow, nail polish, soap, and all sorts of handbags. Nowhere on the list is French wine. And the reason for that is because almost 4,000 comment letters were received in the process of the investigation. And many of them were from US companies that argued and prevailed in their position that imposing additional tariffs on French wine would hurt American companies and their employees. So that's why French wine is not on the list at all, despite the tweet. If you could go back to the prior slide, is it possible to go backwards? Thank you. If it was only France who would be imposing a DST, perhaps this method of responding would be an effective strategy. But as you've seen, many countries are imposing and intending to impose DSTs. There currently are Section 301 investigations into 10 other DSTs. Austria, Brazil, Czech Republic, India, Indonesia, Italy, Spain, Turkey, the UK, and also the EU. It's planned that the decisions on those would be made by December, so next month. To the extent that many of those DSTs are similar to the French one, it's hard to imagine that the outcome will be different. Assuming that Biden becomes president on January 20th and that we don't have two presidents, I would expect that Biden will probably be more diplomatic than Trump. Certainly he wouldn't be less diplomatic. However, if the schedule is maintained that decisions are made on the other 10 DSTs by December, Biden will not be able to unwind them. And the only way to undo them would be if the various countries involved in the EU, of course, would change what they're doing with the DSTs. The second response from the U.S. government is at the end of last month, at the end of September, U.S. Treasury issued proposed regulations making it 100% clear that the DSTs would not be creditable for U.S. tax purposes. I think it was already, that's what we already thought when we analyzed it, but this is kind of the last nail in the coffin. And this is the US government's way of saying that the US is not going to be the piggy bank for the rest of the world for taxation on a gross basis. And both of these two defenses ultimately will end up probably will end up being passed on to the consumers, because who's going to be paying the extra 25% tariffs on U.S. on French cosmetics that are being imported to the U.S. It'd be U.S. consumers, people like me who really like French eyeshadow. And who's going to be paying the French DST? Most likely the US-based multinationals will pass on those extra costs to the consumers who are in France. So ultimately it's the consumers who will end up paying these amounts. And just to make another point, the way that the 25% was determined was by multiplying 3% DST times the amount of income revenue that would be subject to it, and then comparing that to the expected imports of the French cosmetics and handbags, and trying to get a number that would be in the same ballpark but somewhat less. So it's a trade war with an effort to not escalate it higher and higher. The third category is Section 891 of the Internal Revenue Code. And that section allows the president to double the tax rate on countries that impose discriminatory or extraterritorial taxes. This provision has been in the code for more than 80 years, but has never been utilized before. I'm surprised that President Trump didn't utilize it, but I suppose he has other things on his mind. If you could go to the next slide, which I'll just quickly, so on the last slide for this part is that the US government's preferred response is the OECD inclusive framework. And the reason this is the preferred response is because supposedly the OECD inclusive framework consensus approach will involve the following 6 features: tax on net income rather than gross, double tax relief, dispute resolution, only a modest deviation from traditional nexus, and removal of unilateral measures and minimum complexity. So with that, I turn it over to the OECD discussion.
Thank you, Robin. So Grace, can you comment on that?
Yes, first I want to say I don't think there's anyone as diplomatic as Robin of, well, a lot of things in her presentation. I guess what I would say is that we need to put the US response into context. And if we go back to 2015, in the BEPS project, the US and some other countries were not ready to address this issue multilaterally and just kicked it down the road to review it in 2020. However, when the G20 put it back on the table in 2017, they did, as part of the G20, agree to bring this discussion forward at the political level and at the level of the inclusive framework. And they have been very actively engaged in the multilateral discussions and put forward one of the three options that were actually under consideration by the inclusive framework for solving the problem and ultimately fed into the unified approach that we proposed and that is now part of Pillar 1. And they have consistently said through the G20 at very high political levels that they support reaching a multilateral solution. So I guess the US would say they have been approaching the multilateral effort in good faith. And in the meantime, countries have moved ahead with unilateral measures, often referring to those measures by the names of US companies, GAFA taxes, Google taxes, Netflix taxes, etc. How many other taxes can you think of that are named by multinationals? This has obviously colored the way that US businesses, citizens in the US, and politicians have reacted to these unilateral measures in the US, which have been widely perceived as protectionist, anti-competitive measures targeted at US companies and in a discriminatory manner. So it's not really surprising that the US has resorted to retaliatory measures and that they have looked to Section 301. Section 301 actions have the advantage of being measures that can be implemented fairly quickly, can have almost immediate impact as compared to, say, tax measures, and they can be undone relatively quickly if certain actions are taken, as Robin suggested. So they do get people's attention, but I guess the question is, if we don't reach a multilateral solution soon and all countries implement unilateral measures, will the US really impose trade sanctions on all of its trading partners, especially in the context of the worst economic downturn of our lifetimes? We know that US businesses, especially those that are not digital, don't want that. So these actions and any other possible actions the US may take really serve to reinforce the imperative of trying to get a multilateral solution. No one wants a trade war, especially now. At the same time, the US response needs to be seen also in the context of the ongoing negotiations in the inclusive framework, which I think were made much more difficult by the December surprise of the safe harbor proposal last year. This did not really help the ongoing negotiations and may have discouraged some countries from thinking that a multilateral solution could be achieved in the near term, and this may have led them to head towards unilateral measures. So I think we have to put it in this broader context, and let's hope that there will now be a reset in the conversation so that we can move forward and avoid both a tax war and a trade war. Thanks.
Very good, Grace. Monique, what about Europe? How Europe is viewing those measures, those US measures?
Right, thank you, Ana Claudia. Back to the gremlins. Well, I mean, as Robin said, the U.S. didn't want to be or doesn't want to be the piggy bank for the rest of the world. I think a lot of EU member states, sort of think that the U.S. is grazing on the grounds that are not their own without a digital presence. So there's definitely that sentiment. On the other hand, Grace says it really well. I mean, there's just a lot of information that not everybody really puts in order and balances. And if you look at the presentation initially by Jean, we were looking at US and China unicorns, and everybody seems to think that they are losing revenue and to a foreign jurisdiction. And the 750 million worldwide revenue threshold was supposed to indeed look at those really internationally successful unicorns that operate digitally. But what people are also starting to see, and at some point when we get to what the UN is doing, you'll see that that threshold is slowly coming down. I mean, everybody's sort of eyeing, the revenue that can be taxed, not considering the difficulty for companies. So, I think a lot of European countries are not understanding that companies in their countries doing business elsewhere without a presence more and more digitally may be affected as well. So I don't think everybody has added up that particular consequence. So with that, I put the gremlins back out there. There are different views. I think a lot of them don't understand how hard Mnuchin's job is to even get agreement on this. I mean, he doesn't really have the power to decide all of this on the US side. So I think there's a lot of necessary information that is just not out there. But I think the picture really shows you what the general thinking is.
Very good. We will, in a few months from now, for sure, we will remember a lot your gremlins. Not necessarily all the discussions, but the gremlins for sure will be on the top of our minds here. Okay, next, please. So let's start now the third round where the panelists will give additional comments on this digital tax implementation and speak about few about the perspectives of all of this. So we're going to start with Patricia, please.
Yes, I'm speaking here on behalf of the member of a tax committee of UN Tax Committee and representing one of the developing countries, but not coming from developing countries, but not representing Thailand. As you know that the digital world is growing very rapidly, and suddenly COVID came in, the COVID-19 came in. Every developing countries needs revenue. Every country needs revenue. So we foresee that it is important that there must be something in the UN tax model that is an alternative for developing countries who opt to have the unilateral measures. So as you all know, that last committee meeting last month, we discussed a lot about the inclusion of the Article 12B, the withholding tax at source, the income from automatic digital service under the UN model. And the proposal has both the withholding tax at source or net profits. I will not elaborate in details about the details of the article, but because we have been talking a lot already. The rationale is that we foresee that the proposal global solution is way too complicated for developing countries, even though there's a global consensus, but for the aspect of tax administrations from developing countries, it is quite difficult to implement. We foresee that this Article 12B will be an alternative solution for countries that have withholding tax unilateral measure under their domestic law. So the article itself doesn't give the taxing rights. Each country must have their own domestic law before can opt for this article. And also is that we think that this will be provide a double taxation relief for withholding tax for the unilateral measures. We all know that this is not perfect solution, but at least this is a voice of members from the developing countries that there should be an alternative solution for developing countries to have their own choice in their negotiation under the models. So what is next? At the end of 21st session, it is agreed that this article will be added to the UN model. The UN Tax Committee will work on to improve the article and commentaries, which will also reflect all minority views in the article. Next month, we will have the subcommittee meetings, and the text will be finalized at the 22nd session in April 2021. So this is the development from the rationale and the response and the development from the UN Tax Committee. Back to Anna. Thank you.
Thank you, Patricia. And now, Belima, please.
Thank you, Anna. Right, looking ahead, well, we can see that COVID has led to increased urgency in raising tax revenues, and there are several reasons for this, and I'll just pick up two. First, there's been a drop in economic activity, and that, of course, leads to an attendant drop in tax revenues. And there's also been increased digitalization as a lot of activities have shifted online due to COVID. So, of course, governments everywhere, Africa being no exception, are looking at this as a sort of spur to sort out their digital tax policy. So what do I expect to see? I expect to see more unilateral measures from Africa, especially given that there isn't yet a global solution on the table. I'd like to take a minute just to comment on Article 12B of the UN model. I think it's a welcome development, but some caveats anyway. As we all know, treaties do not create taxing rights. So as Patricia explained, such a provision, if actually included in a real-life tax treaty, would only be workable where there is a domestic tax regime that already levies a tax on automated digital services. From the African perspective, many countries do not have such legislation in place. And those that do have different types of tax regime, not the one that this model is meant for. So for example, the significant economic presence rules, that will not work with this UN model article. And in that case, those type of rules will continue to be overridden by PE clauses in tax treaties. Also worth pointing out that ATAF has argued in respect of this Article 12B that it is not wide enough, because it only addresses the scenario of cross-border payment. So there has to be a payment before this article will bite. However, when you look at ATAF's recommendation for DSTs in Africa, those DSTs will apply even where there is no payment, because the way it is proposed is that if a revenue is deemed to arise in a jurisdiction and deemed to be taxable there, even if no payment has actually been made, what we are focusing on here is the value being created in that jurisdiction, irrespective of whether or not a payment is made. So putting that side by side with this UN provision, we would see that there would be seriously at odds here. Now, looking forward in terms of prospects and challenges, one thing I'd say is that it's one thing to have a law on your statute book, but quite another thing altogether to implement that law successfully. There are issues to do with complexity, which we've already mentioned earlier. For example, how do you identify the taxable activities? How do you determine quantum of revenue? How do you ensure compliance? And these are problems everywhere in the world, but even more so in Africa. So I still have a bit of reservations on those points. Overall, we should expect to see a raft of domestic measures coming through. But regarding successful implementation, I think time alone will tell. Thank you.
Thank you, Belima. Thank you, very interesting. And now we go back to Shefali. Shefali, please.
Thank you, Anna. So just a few incremental points. We heard from Patricia and we heard from Belima as well. The developing countries are looking to introduce these measures just to counterbalance, in case there is a delay in reaching the global consensus. And of course, while Robin did, share her perspective on the USTR investigation, but the countries that have implemented DSTs, they do believe that these are not really discriminatory against any particular country. I think this just, at least India's viewpoint, is that it just creates a level playing field with the domestic e-commerce operators. So clearly this is more just to neutralize the effect or to take away any impact on the competitive landscape as a result of the tax arbitrage. Also on the point of extraterritoriality, at least India's viewpoint has been that the Nexus rules are evolving and should evolve based on the different business models. And, this way of digital or whether it is equalization levy or withholding taxes or the new UN proposal of Article 12B, I think that addresses some of these issues in relation to nexus rules. So clearly, these are different, perspectives from two different sets of countries. And one more thing that goes in favor of these unilateral measures, or more in favor of the gross basis taxation, is that whether it is the Article 12B or some of these other things, they don't really require the multilateral agreement. Like, for example, one of the biggest factors in favor of the UN proposal of Article 12B is that it does not really fall back on a multilateral consensus. Bilaterally, if the two countries agree to a certain position, they can quickly come together and amend their tax treaties to bring in some of these provisions. So it can be implemented much faster than what a multilateral structure would take it. But of course, there are concerns, and rightfully so, in terms of how do you then address the loss-making businesses, and how do you address the initial investments. So clearly it is not a perfect solution, and we will have to find some balance there. Also, to ease out the compliance burden on the multinationals, there need to be consistent rules on how these taxes are likely to be implemented. Because clearly, there are different thresholds everywhere. There is a different incidence. Like, for example, in India, you don't have a system of consolidation at the group level. So each company within the group that earns this revenue, which is in scope, needs to do its own filing and get its own tax registrations. So at least in the meantime, while these unilateral taxes still there, it might be good to have some consistency and best practices to ease out the compliance burden. And then, of course, the last question, you've already seen a lot of reactions from the participants as well. Who will ultimately bear these taxes? Again, it's clearly a market, demand supply equation. The companies that can afford to pass it on may pass it on, and there will be some who will, decide to bear the taxes, especially if they are just an interim measure till the time some global solution is reached. So with that, I hand it back to you, Anna.
Thank you, Shefali. Thank you. And here we are with the gremlins again. Very interesting views, always from Monique. Monique, please.
So the question really is will there be a consensus in Europe towards a common corporate consolidated tax, one way or another, on this? So let's go back to where this whole CCCT thing comes from. The common corporate consolidated tax base was launched in 2011. It didn't survive, and then it was relaunched in 2018. What is important is at the very beginning, a major lobby started, and every country looked at that particular tax proposal and ran the numbers. The study was like, well, what is it going to mean for me? The Ireland's and the Netherlands and some other EU member states figured out as they were service rendering jurisdictions that they would really opt out here and lose major revenue, which of course they were not willing to accept. So at that moment in time, that consolidated, harmonious proposal, even though the idea is definitely a good idea, it would resolve a lot of compliance issues. And it would come up with a predictable, reliable way for our corporates to allocate their taxable revenue among the EU member states. It just didn't fly because everybody was, at the end of the day, only looking at the four corners of their jurisdiction and not looking at what it would mean for business. So where are we now if we're looking at the DSTs? Well, the digital PE has been a long-term proposal that was supposed to be included in the CCCTB. And it was recommended that EU member states would amend their double tax treaties to implement rules on digital PEs and attribution of profits resulting from digital activities. So far, so good, right? Now, of course, to make it really simple, once someone feeds the gremlin after midnight, we're back at major trouble, right? So I really would wish that I could have a very positive response here, but we'll have to see how the EU is moving forward and whether it can persuade the EU member states to get on board and have a common proposal on this. And with that, I hand it back to you, Ana Claudia.
Very good. Thank you. Thank you. So speaking about LATAM in relation to LATAM countries, as we saw, there are few countries that implemented digital taxation measures, or that have countries, or in case of Brazil, there is no specific digital taxation measure, but anyway, there is withholding tax broad enough to get digital services as well. What we see here is, for the time being, is that most of the measures are based on withholding tax, which in one side it's good. Well, in one side it's good because it's, as Sheila commented, this point of credit is something that is very much concern for corporates. But it, by being withholding tax, it also we also have to observe whatever treaties each of the countries they have in place, it's we don't see any kind of movement of Latin countries towards proposing the implementation of digital PE for the time being. So it's more focused on withholding, as we said. But anyway, by being withholding tax, it can be in one side. It can there is this positive side of being creditable and being subject to treaties, to treaty provisions. But on the other side, you may end up, depending on the rate, you may end up with so much withholdings, being a disincentive for companies to invest in a certain country. So it's necessary to measure this. And we also have in this part the views of the US. So Robin, please.
Thank you. As I said before, the DSTs are not welcomed by US tech companies. It's a double tax to start out with because it's not instead of corporate income tax, it's in addition to corporate income tax. So I know that the other countries feel like the US companies are unfairly taking profits from their country or taking revenue from their country, but the US companies are also subject to tax in the US. So I think that is really the main problem with the DSTs, that they're imposed on a gross basis. The unilateral measures will result for sure in multiple taxation because they all have different rules and different bases and different everything. And the US companies disagree with the OECD tax talk number 17. I have a clip from it, but I'm going to skip it in the interest of time. Basically, the economists at the OECD concluded that it's not a big deal for the world because the companies that the DST or the OECD version of the DST would be imposed upon are big companies that are insensitive to more taxes. And I would say that those companies would not say that they don't care about more taxes and certainly would rather put the extra money into more R&D. Nevertheless, even though US and the companies disagree with that point, the US and the companies certainly would greatly prefer the OECD unified approach because it's by far the least worst or the best option. Right now, Pascal has said that middle of next year is when he expects the agreement to be reached. Even if anyone can do it, it would be Pascal, but it's hard to imagine how 137 companies will all reach a consensus. And even once a consensus would be reached, implementation requires a lot of extra steps, like modifying treaties and changing, legislation in different countries. In the absence of a unified approach, however, extreme chaos is likely to result due to the complexity and time-consuming nature of having to stay on top of all these different rules that are constantly changing, and they're all different. the absence of dispute resolution, forum and procedures, and the likelihood of ridiculous trade wars and retaliation, which are very primitive conflict resolution tools. And I'm going to skip my next 2 slides in the interest of time.
Thank you, Robin. So now we have Grace.
Yes, thank you. Well, it's hard to comment on everything that has been said. I guess I'll start with maybe just what Robin mentioned about what was discussed in our tax talks. What we have consistently heard from business, whether we're asking business through surveys about tax incentives or tax certainty, is what we have heard is that tax is not the major driver. And so that, I think, is what is underpinning what we have said in our economic assessment about the ultimate effect of these measures. But turning more generally to what we've been discussing, I think this discussion shows very clearly that we're at a critical juncture. We've heard that there will be more African DSTs. We have the UN initiative. We see the EU ramping up the activity and pushing very much to establish their own solution should the OECD not come up with something by the middle of next year. That is the deadline that the G20 has set for us. That is also the deadline within the inclusive framework. If you look at our reports, that's what we're aiming for. And I do think that it can be achieved. Why do I say this? Well, if you look at the 2 blueprints that we put out, these were agreed by the inclusive framework, and not just agreed, but they also specifically agreed in the overarching statement that they form a good basis for a solution in the future. And so while, yes, there are technical issues that have to still be addressed, those can be addressed. The big question is, can the political issues be addressed? The larger issues about scope, what the thresholds will be, what's in, what's out. These are key questions that have to be resolved at a political level. And so we just need to see what will happen. I do believe that we now have an opportunity to reset the discussion now that the elections are out of the way in the US. And not that I think that there will be a fundamental shift in the US position, but certainly the atmospherics of the whole campaign, et cetera, will be gone. And so we can look forward to what Robin described as a more diplomatic approach in trying to get to an agreement. And I think there's tremendous pressure on all countries. I think the countries, the vast majority at least, that have implemented unilateral measures are very interested in a multilateral solution for all of the reasons that I mentioned earlier about fairness, compliance burdens, tax certainty, et cetera. A multilateral solution is a much better one than unilateral. And I'm not even sure about a bilateral treaty approach as suggested in the UN context, simply because you would need to get those treaties with relevant countries. And are those countries likely to sign up to what has been proposed? And so you might get, 2 developing countries signing up to what's being proposed, but will you get the key countries where the digital activities are coming from? Will you get those to sign up? So I think a multilateral solution really is the way to go. Now, whether we will get there, I think depends very much on the willingness to come to a political agreement. And if we don't get there, well, then we may end up with a world of uncoordinated unilateral measures for a while with, retaliatory measures. But then I think ultimately we will end up coming back to the table looking for a multilateral solution, because I don't think that having a multitude of unilateral measures out there and trade wars going on is going to be sustainable in the long term. So let's hope we can get there. And we certainly have the elements, we think, in the Pillar 1 and Pillar 2. I do agree that the pillars could use some simplification, and we look forward to everyone contributing through the public comment process. You still have a month to submit your comments. We've already received at least one, I think, yesterday. So we would welcome that that input, in particular on the whole issue of trying to simplify the approach. So I remain very optimistic. Thank you.
Thank you, Grace. It's good to see your optimism for sure. And Sheila, what are your views on this?
Okay, hopefully I'll be mirroring a lot of what the last couple of speakers have said. But basically, I think what the corporate sector is expecting over the next few years can be summed up in one word, and that word is uncertainty. Will the OECD reach consensus by the middle of next year, or are we going to see more and more unilateral measures? Will the EU proposals be implemented, and so that we end up with almost a two-tier or multiple-tier DST systems? If there is no consensus at OECD level, are corporates still going to have to monitor revenues on a country-by-country basis, or will we see some better level of clarity and consensus around what will be qualifying revenues for the purposes of a DST? Will the cost be passed on? I agree with Shefali. It's clear that where a taxpayer's market can bear it, those costs will be passed on to customers. I mean, we've already seen it with certain big players in the market. So realistically, you know, this is a tax that should concern all businesses and taxpayers, and not just the technology or the digital players. One question, you know, will DSTs ultimately be extended generally to online sales? As Grace mentioned, and there has been discussions in the UK press, you know, questions about a business rate equivalent for digital retailers, as they have a natural unfair advantage. E-commerce is already taxing India. The UK is considering it. So, you know, if that's the case, it's likely to be a cost to anybody making online purchases. And I can tell you that's certainly going to hit my pocket. A big thing is the role of the group tax departments is going to have to evolve. And if tax departments aren't already doing this, they are going to have to partner more closely with businesses on a real-time basis to understand commercial strategy and new products that are being developed. The tax department are going to have to be able to advise early on whether a DST needs to be considered. You know, effectively, tax will now have to be engaged at business plan time, as a DST is going to affect costs, it's going to affect cash flow, it's going to affect pricing, how customer contracts are drafted, and getting the tax people involved, you know, after the fact is just going to be too late. And sort of the last thing really is, you know, and I've already discussed this in detail, is the expected increased compliance burden. And this shouldn't be underestimated. Businesses are going to have to invest in new software and people who can track developments. Cash spent on compliance is cash that's not being invested in the business. And then what happens if there is OECD consensus? Do taxpayers then suddenly have to transition over to new systems? What will the lead-in period be? What happens, you know, when we go from an EU interim system to the long-term proposals? You know, all these different changes do, incur different costs for businesses. And then on the other side of the coin, you know, will the tax authorities actually be able to handle the compliance burden on their end? You know, we talk a lot about the corporate sector, but really, I haven't really talked about, you know, the tax authorities. What will tax authorities' positions be in early years in terms of leeway for penalties for incorrect compliance. And then, finally, what about jurisdictions that don't support DST? We've seen retaliatory tariffs issued by the US. Will these still stand in January? I mean, Grace made an excellent point. Will the US really want to trade war with all its trading partners going forward? So, this really brings you back to the fact that this is a tax that needs to be a concern for all businesses and all taxpayers and not just the digital players. So really, if that's the one message that I can give you to take home today, I think that would be it.
Thank you, Sheila. You see so many aspects to be considered and so many things happening in the world while we have all these discussions ongoing. And before we move on to our very final part of the tribute, I wanted to check if we have here we have here a lot of very interesting comments and some questions. I don't say a few questions. I'd say in comparison with the comments here, and we could go through some of them and. Then you can comment on. I think one of the points that is here, it's a question presented by Mario Maldonado, has to do with source income basis that says if this is a better system or not. If in his view, source income as base of digital service is a better system. It eliminates this uncertainty. What are your view? So I see that many countries are moving towards this withholding or DST systems, but saying that it's better or worse, it's very difficult to say. So let's go around. And because this is, I think it's something that is significant, and just listen 1 minute each of the panelists here. So we can start with Monique. Monique, do you think it's a better system if you just tax on the source?
Well, I don't think it matters too much when I think about it. I mean, you've got the existing tax systems, and I don't think residence-based taxation countries are going to switch, to source-based taxation or the other way around. We'll just have to live with it, and that's why we have treaties. Does it make it easier? Yeah, of course it's easy because, hopefully you can track the income and you can tax it, but you may not have all the information on what the actual tax cost is to the company that's earning the revenue from that particular source. So it may be profitable at source, seem profitable at source, but overall it may not. The company may have a loss.
Thank you, Robin.
I agree with Monique, but I also think that probably a more efficient way to deal with it would be like a consumption tax or a VAT, because it would avoid the need to change all of the existing rules and treaties and legislation. It would just be kind of an add-on to a VAT, because I think ultimately it will be passed on to the consumers.
Bilima?
Thank you. My view is the same as Robin's. I do see the appeal embedded in the question, but I think that the way forward for this sort of thing, I would posit more that it should be via consumption tax or something like that.
Thank you. Sheila?
Yeah, I mean, I agree as well. I think a consumption tax with some kind of input credit would be fairer. I mean, I want to quickly alight on a couple of queries that I've noticed people asking, if a digital service tax is going to make a product unprofitable, will a company just, decline to launch it? you know, in a particular jurisdiction, you know, at the end of the day, tax is generally not going to be a driver. I mean, in often cases it will. You know, a business might, you know, might agree to launch a loss leader in a particular jurisdiction in order to get a market foothold or to, you know, to access other clients. So, you know, whether or not a product is loss making is not necessarily going to be the final answer as to whether or not it will be marketed. But I do think, you know, where the threshold to be impacted by digital service tax is lower in some jurisdictions, that certainly is going to be a factor to take into account. And you could find that, you know, certain businesses are just not going to launch certain products in, you know, in different countries, which presumably would, you know, would be completely contrary to the whole concept of equity and fairness.
Thank you. Grace?
Oh,
Grace?
sorry. Yeah. No, sorry, I was looking to unmute myself and I see that I was already unmuted. I guess I would tend to agree with Monique on this. Yeah, I think enough has been said already.
Very good. Shefali?
So I think that while consumption taxes, you know, it's good, but, you know, they are definitely being passed on to the consumers. So if this is supposed to be a tax on the income, then some form of a withholding tax might be more appealing and easy to administer. But of course, you know, I do understand that, you know, consumption taxes have their own appeal, and they are definitely much simpler and easier to, you know, apply. But if you increase the consumption taxes, which are definitely then, you know, borne by the customers, then again, I think it just makes the products very uncompetitive. So clearly, if this is meant to be a substitute for an income tax, then, you know, it may not be right to include or just add them up to the consumption taxes.
Very good. Thanks. And Patricia?
I couldn't agree more with Shefali, because even though indirect tax is easier to administer and it has been implemented already, but I think the fair share of income tax must be allocated. So Shafila has said everything that I have on my mind, so I support what she has been saying.
Very good. Thank you. Thank you. And in interest of time, I think we are we cannot finish without a tribute to Carol Tello. Carol Tello was the very first IFA USA president, and we asked, as I mentioned in the beginning, Peter Connors, IFA USA chair, to prepare a small tribute to her and to speak about plans that IFA, very interesting plans, by the way, that IFA USA has to honor Carol, that we'll see now. So Fabiola, please.
Hi, everyone. I'm Peter Connors, and I was invited by Anna to a very short tribute to Carol. I'm speaking to you today from my home in Princeton, New Jersey. I hope you have enjoyed today's meeting. As most of you know, Carol passed away in August, rather unexpectedly. I had the pleasure of working with Carol since February as the Executive Vice President of IFA USA, and I took on the role of Acting President also in August. Carol was IFA USA's first female president. Her election as president was celebrated throughout the organization earlier this year, and today we continue to mourn her loss. The women of IFA owe a great deal to Carol. It was through her persistence that the glass ceiling was finally broken. And as in many other organizations, there was plenty of resistance along the way. I also owe Carol quite a bit. When I met her in 2000 at a BNA meeting at the Waldorf, she asked me if I was interested in updating the branch profits tax portfolio, which I did. It was my second portfolio, but it was my first serious foray into the international tax publication arena. And Carol graciously selected me to serve as Executive Vice President last fall. Without her support, I would not be here today. A highly skilled practitioner, Carol was a regular on ABA and IFA panels. I remember what a superb job she did in May as moderator of a panel on the very complex anti-hybrid regulation. Carol has left her mark on many aspects of IFA. It was she that led the effort to prepare tribute to Marianne Burge as part of our Heritage Project video series. It was Carol who created our diversity and inclusion affinity group. And it was Carol who organized the branches of Women Affinity Group and who was instrumental in assisting other women's progression in IFA, including the appointment of my dear friend Jean Goulet as WEN representative at IFA Worldwide. As some of you know, it was only at the London meeting in 2019 that WEN became an official group of IFA. And I would be remiss if I did not note how supportive Carol was of our young IFA members in the Yin Affinity Group. I am pleased to inform you that an international tax lecture series has been established in Carol's honor. It will be funded by a combination of IFA, the ABA, and the IBA. IFA USA has committed $10,000 to jumpstart the series. The lectures will be held at the University of Maryland Law School and the Georgetown University Law Center, both of which she attended. The first lecture will take place in November 2021 at the University of Maryland Law School. Jean Goulet put it best. Carol was a true pioneer who forged an unconventional way to have it all, an outstanding career and a loving family life, in which she also found time to pursue her passions of cooking, gardening, and entertaining. Carol is survived by her husband Jim, an aviation lawyer, and her daughter Anthea, a surgeon. Thank you for your time, and once again, I hope you have enjoyed today's meeting.
Very, very good. So with this, we finish our panel here. And I thank you all for such a great job and for being with us here, for a great job of the panelists, of our secretary. Please join and follow us on the social medias. We are present in different social medias, and follow us, follow WEN activities. Thank you so much. Thank you, the panelists. Thank you, all the attendees, for your interesting comments, for staying here with us up until now. And with this, I think I need to pass the word to the Master of Ceremony, Han.
Ladies and gentlemen, I want to thank the participants, and in particular the panel and its chair, Anna Claudia Utumi, for this interesting WIN seminar. As announced earlier, the postal sessions will now be open for half an hour. Tomorrow we will attend the YIN seminar that starts at 3 p.m. And before that, the postal sessions also can be visited between 2:30 and 3 p.m. Central European Time. For this moment, I wish you a pleasant rest of the day. Until tomorrow.